Hey, welcome to the Guaranteed Retirement Guy Show. My name is John Stevenson, and today we're going to be talking about whether or not you are better keeping your pension or purchasing an annuity, maybe with a lump sum payout. So I have lots of people who have pensions who reach out to me and they're like, okay, I've got my pension. It can give me this as a single payout or maybe a joint, or maybe it's a joint. It'll give me 100% and give my spouse 50% later if I pass away. Like a lot of times they're set up like this. And there's lots of different pension providers out there. They're becoming less and less all the time. And so people will compare them, and you should be comparing. There are a lot of annuities out there, and that's what a pension is. It's an annuity, and so is Social Security. That's an annuity, okay? Annuity is just a lifetime payout. It's a guaranteed lifetime payout. And once you annuitize it, okay, then you're set for life, which is great. Like people love it, and that's why annuity holders live longer. Statistically, they live longer because they just don't have to worry about the income. They know it's coming in. They know they can count on it. So it's really nice. So when people reach out to me, they're looking to compare different options because I have access to thousands and I look at all the options for you. And if you want to look for yourself before talking to me, go to my website. It's johnstevenson.com, and you can look at all the annuities that are out there. SPIAs and DIAs, QLACs, income riders, you name it. Income riders typically pay out the most. So if you're looking for high pension income, not always, but usually they pay out the most. And I would say most of the time when people reach out to me and they're comparing numbers, the annuity options that are on the market are way better than what you have. So I would just, fair warning, before you annuitize or take your pension, make sure you look elsewhere because usually there are better options. Okay, not always. Every once in a while, there is a time where I'll see a pension that is better, and I'll just tell them, just stay where you're at because it's better there. But most of the time, that's not the case. Okay, and I'll share my screen. I'll show you some scenarios. But again, I would invite you, go to my website, johnstevenson.com, and look at it for yourself. Okay, and then if you want to purchase an annuity, please book a call. There's a link below this video, and there's a link also on my website where you can book a call there too. So we'll get on a Zoom call, and you can ask me questions. I'll ask you questions, and we'll get to know each other, and I'll show you what's available. So I show everything. I'm really transparent. I think it's important because a lot of these pay high commissions, low commissions. A lot of times advisors will kind of push the high commission product, but it's not usually the best for you. In fact, I would say 100% of the time, it's not the best for you. It's usually just always the best for them. And you're getting a decent payout, but it's not as good as what you could get. So anyways, that's important. Definitely do the research, but you need to be able to know where to go. And so if you go to my website, my website plugs into all the carriers, and you'll be able to have that feed directly for your own benefit. So anyways, all right, let's take a look at my screen, and I will show you everything that's available, and we can kind of go through some numbers together. Okay. All right. So let's say, I'm just pretending here that you got a pension at $450,000. Okay. And you're 62, your spouse is 62, you're going to take income in 2 years. And you're thinking, all right, well, my $450,000 pension will give me $30,000 a year, or maybe it's $25,000 a year. Then I'll be showing you, well, if we take the same 450 and we plug it in, here's what it's going to give you as a joint payout. It'll never go down. Okay. Maybe your $30,000 that you're getting in the other pension, maybe that'll be cut by 25% or 50%, which a lot of times it is. So you look at that and say, okay, well, what about a single payout, John? Can I get more? Of course. There you go. It's like a lot more. So, but again, you have to realize if you do this and you take income, it will not continue to your spouse if you pass away. And if there's no more account value, they will not get a death benefit either. So anyways, this could be good. Just depends. And if you got a life insurance policy or other cash for them to create more income for themselves, then that might be a good thing to do. So, but based off of this, you can see the account value will be exhausted by the time you're 75. Okay. And that's with index growth. If there's no index growth, it's going to run out sooner. It'll be like 71, 72. So just remember that. Okay. This is for lifetime income. This is what it's set up for. And it definitely will pay out for as long as you live. And it's very good. I mean, the lifetime payout by the time you're 95 is this amount. If you live longer, it'll be more. So I love that. You just have to realize though, this death benefit over here, that lasts for as long as your account value does. So your spouse will get that, but only for as long as that's there. Okay. And a lot of times that money that comes out is not enough to create the same amount of income you're used to. So I usually just tell people, if you're going to do this and you're married, you should do a joint if your ages are close together and if they rely on you for income. So, and if 35,000 isn't enough, see what your pension will pay out in 5 years and compare it with this. Okay. And make sure it's a guaranteed payout. Don't get some hypothetical scenario. Make sure it's an absolute one. Okay. Because when I'm showing you absolute numbers here. So this is based off of 5 years. The same $450,000. You let that thing sit and grow, and you let it sit for 5 years. your income guaranteed contractually for joint is $46,856. Never go down. Okay. So that's really important when you're kind of comparing these. Pensions are all over the place. I mean, some are pretty decent, but most aren't. Most just don't pay out very much. And, it's easy just to flip the switch over there, but it's just as easy to do this. I'm just telling you with a lump sum pension, it comes from a lump sum deferred taxable money, and it'll go into an IRA with the carrier holding this annuity contract. It takes about 3 weeks. You submit the application, that gets approved after a week. After that, the funds get transferred as a 1035 transfer, goes into your new IRA with this new annuity, and now you got more income from the same money. So that's how it's done. And I do those all the time. So, and if it's a 401k or TSP, those are easy too. So happy to help. If it's cash, it doesn't matter where it is. Okay. I don't care what kind of money it is. I deal with all of it. And if you have questions on that, you're thinking, man, how would this work for me? Definitely go to my website, check out the calculators for yourself and see and compare your pension and compare what your lump sum would be and just plug it in and see, does it work? If it works, great. One thing to remember though, with the income rider calculator, when you get in there and you start producing some numbers, okay, I'm just going to tell you, there are some that will pop up that are a little bit higher. Okay. They are accelerated payouts for a time. Okay. Usually for 5 to 7 years, and then they reduce 30%. Okay. Let me show you. Here they are. You got American General, you got one from Emeritas, NASA, and so on. So you look at this and say, okay, we already know this one never decreases. We've already established that. But some of these pay higher. But look at this. At age 72, it goes down to 35 grand. You might be wondering, well, why would anyone want that, right? Well, it's because some people retire early. They're like, well, I want to retire at 65, but I'm not going to take my Social Security until 70. I want to maximize it, right? And so what they'll do is they'll take a larger payout, accelerated. And this one accelerates, it's not bad. It's like 7 years. But then it drops $20K. That's a lot. Okay. But, they might be thinking, well, I got my pension starting later and I've got my Social Security starting later. It's perfect. It'll bridge the gap for this period. It'll allow me to retire earlier and still have the income that I want. So in that case, it's perfect. Otherwise, there's other people that are like, I'm just unhealthy. I don't think I'm going to live very long. And I want something that's going to pay me for as long as possible, a larger amount. Then that works out good too. So I just want to make sure you're aware. So when you go to my website, especially when you're looking at the income rider, some of those top ones will pop up there. And I just wanted you to know which companies they were. So anyways, if you're looking to purchase an annuity, please reach out. I'd love to help. I'll show you everything that's available regardless of what I'm getting paid. And if you got questions, comment below. If you like the video, like, subscribe, share. I really appreciate you for watching, and we'll see you soon.